Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, an aspiring investor, maybe you're an industry insider, or maybe you just love the idea of creating passive income and generational wealth through investing in multifamily apartments, well, fortunately, you are in the exact place you should be, because we are doing another episode of the Gray Report, doing a Gray Report newsletter roundup and recap, touching everything that happened in the multifamily industry, real estate, and the economy, breaking it down myself as well as the Director of Communications and Marketing here at Gray Capital, Matt Bosnagel. Matt, let's bring Matt in just right away from the top. We're going to try to do a relatively concise, we're trying to be efficient. We're trying to value and appreciate your time. So we're going to get right into it just after a brief word from our sponsor. This episode of the Gray Report is sponsored by an unnamed upcoming multifamily investment opportunity from Gray Capital, only open to accredited investors. But if you are an accredited investor, hop on over to graycapitalllc.com, join the Gray Capital Investment Club, and stay tuned for future opportunities from Gray Capital. All right, Matt, how are you doing? How are you doing this week? It is July 8th. You have a nice long weekend, 4th of July, Independence Day weekend?
Oh yeah, with these long weekends, I'm always just ready to get back to work.
Exactly. I know. Well, we've got a couple things going on, so it makes sense. But it's all good stuff. So, all right, let's get right into it. Gray Report newsletter. Again, you can sign up for the Gray Report newsletter going over to graycapitalllc.com. You'll see a button that says sign up for the free newsletter. Sign up for it. And then every Thursday morning at 8:30, you're going to get this newsletter packed full of all the latest research reports, articles, opinions. Again, multifamily industry, real estate, and the economy delivered straight to your inbox. All right, the theme of today's newsletter is Summer of Opportunity. Matt, we've seen quite a bit of opportunity in the markets this year. What are you seeing?
Yeah, well, and I said this earlier and we were talking earlier, and I think it feels risky to predict that the economy will do well rather than poorly. If my predictions of apocalypse don't come true, then well, that's great. Then economy keeps going. But if you're wrong, and if you say it's going to do great, and it does bad, then it's not so nice.
Well,
but even
yeah. Well, no, yeah, it's. I think it's more exciting to talk about doom and gloom. I think that gets more attention and more clicks. But man, the doom and gloom guys don't get it right that often. And I think if you, and they're usually defaulted in doom and gloom. I think if you defaulted to optimism, I think you do much better. But you also just have to have a realistic view of what's going on. So
yes. So and take my opinion. This is just an optimistic take, and I'm thinking that this is the summer of opportunity. Inflation potential is still there, but I think the markets are behaving with a little bit more rationality than exuberance. Stock market investors seem to have reined in their enthusiasm somewhat as labor shortages and material shortages continue. And I'm taking this introspection as a sign of stability rather than decline. I think that people are starting to look for stable investments, and really they need to look no further than commercial real estate in the multifamily market specifically. I think that the sky's the limit attitude towards prices in the home buying market in single family homes has really gotten some home buyers scared away from especially first time home buyers and their remaining renters. And that's driving apartment demand higher. So that there's a lot of factors that are making commercial real estate, and especially multifamily, a strong, stable investment.
Yeah, I think it's pretty clear that the housing market in general is it may be as strong as it ever has been, because I think we've got a good article in here about household formation has been skyrocketing quite a bit, and there's a lot of demand for single family homes, rentals, single family rentals, multifamily rentals, everything. Occupancies are way up across the board in most markets, even in those gateway markets that had quite a bit of softness last year. So yeah, I think there's reason to be optimistic. Not just saying it because we're trying to syndicate apartment deals, but it's true. This is the most exciting time in my real estate career. Certainly the past, really starting with last year, just the uncertainty, and now this year with this roaring back, this roaring recovery. And again, I still think we're kind of at the, some things, maybe we've seen peak price levels like maybe in the auto, like used car market, but a lot of things, people are still just getting back to work, which is crazy to think because we've been back to work for quite some time. Okay, let's get right into snapshot rates and markets. And this is really wanted to talk about this, and we touch on this every week. Let's look at this 10-year U.S. 10-year Treasury yield. Again, one of the most important numbers in capitalism, really in general. So much debt is indexed to the U.S. 10-year Treasury. It also gives us a little bit of insight on inflation and growth, and really the cost of capital. Looking out, on a 10-year term, and earlier in the year, really starting in February, we saw the 10-year Treasury do a huge run up. Kind of hitting that 1.75% mark here, back in early April. And we've seen some declines ever since. People were saying, once we've reached 1.75, we're on the way up to 2%, which would be, relatively still historically low, but like somewhat normal. Right now, as of 4:55 p.m. on July 8th, it's a 1.29%, and that's gotten a lot of folks kind of scratching their head. Because the bond market's supposed to be like the smart money, and it's supposed to be a really good indicator. It's supposed to give us a lot of information, but where people are wondering, okay, there's a lot of inflation. Why is the 10-year at 1.29%? And I think that is what has caused, I wouldn't even call it a sell-off, but a little bit of hesitancy in the S&P 500 in the stock market itself. So let's keep watching that 10-year Treasury as it is a critical metric and number. 30-day LIBOR essentially unchanged, though. Those shorter term maturities, LIBOR is being phased out, coming in at 0.1%. SOFR, the replacement for LIBOR, coming in at 0.05, down just a little bit. It's essentially zero, though. You're basically just paying the spread your lender is charging you. And a lot of these new loans, if you're going after a multifamily project, make sure are you indexed to LIBOR or SOFR? It may not make a huge difference because you're probably just paying the spread, but definitely you need to know that. And that spread between the 10-year Treasury and the 2-year Treasury, it's declined a little bit, narrowed. We're at 111 basis point spread. HUD 223F rates right at 2.3%. Then the HUD 221 D4 coming in at 3%. And then Fannie Mae and Freddie Mac, kind of the agencies. Again, this depends on the term, the location, the sponsor, and other factors, but coming right around 3%. The S&P 500, what we were just looking at, coming in at 4,358. But the iShares residential ETF, tracking a bunch of apartment REITs, coming in at $85.93 per share. Gold spot price per ounce, 1,798. Steel, it's relatively, I think like it's leveled off a bit, coming in at $1,751. And random length lumber futures certainly have come down since the peak about a month ago, $810. Crude oil, a little bit down from last week, but still relatively high, still probably going to be moving up, $71.78 per barrel. Bitcoin, $33,342 per BTC, and then Ethereum, $2,282 per ETH. So, so it's interesting. We got to keep tracking the market, seeing what's going on. I guess, Matt, do you have any thoughts? We were talking about a little bit the stock market. You were mentioning kind of markets in general. A little bit of, I think you said it the right way, a little bit of introspection of, what is really going on? Are we really going to see that crazy inflation, or we're going to see strong growth, and then is it going to level off to normalcy? Because once all these price pressures, supply bottlenecks, I guess why wouldn't we go back to at least growth rates that were, relatively, they were positive, but they weren't, our growth was slowing pre-COVID. We were kind of in a slow growth economy. Got any thoughts?
Yeah, it was reassuring that when you see higher prices and shortages, that there's was a reaction. People stopped doing something when there was higher prices. When people keep buying and driving it continually higher, that's when I get nervous. That's
Yeah.
when it seems like there's more uncertainty there. I can understand. I have a little bit more certainty when there's a price goes up, there's less buyers, and I think that's what we're seeing. What we're seeing a little bit in the stock market, and a little bit even like I mentioned before in the housing market.
Yeah.
It's it is interesting, also to keep in mind, lumber used to be twice the value of what it is today. So even though 810 or however much it is at this moment is certainly elevated, but it's not nearly what it used to be.
It's not as insane. I think that's a good point, but it's way down off of its highs, but it's still, and I'm just pulling up the kind of the longer chart, because it's a good point, and all things are relative, right? That we're down off of the highs, so significantly down. But just to zoom out a little bit more,
That is exactly what I was doing last night.
Yeah,
trying to figure out the ballpark, where it should be, and it's so hard to measure this last year. You really have to spread it out across several years to see any kind of pattern.
I agree. And because we peaked at 1700 basically per whatever random length board of lumber. We're down $1,000. But again, we were at 600 back in 2018, back closer to 300. I mean, we're still double of what it was in 2019.
Yeah.
And even I guess what's the trend, what is the exact trend line? It's hard to say for sure, but it's interesting, and who knows, it's a pretty much a fool's errand to see where lumber should be, where it shouldn't be, and but yeah, it's fascinating. And again, so it's like not really following any kind of natural trends. It's just because COVID happened. So crazy stuff. All right, let's get right into the articles. Let's get right into it. Matt, where did you want to start? We had this really great Marcus and Millichap article come out about the hot housing market spills over into multifamily rentals. Is that a good place to start, would you say?
Yeah, that's what. And I was kind of, again, this is the third reference to this. It seems like there are signs that we're approaching a limit for single family home prices. There is a ceiling. More people are choosing to hold off on purchasing a home, and they're choosing to really remain renters instead. Home sales were 44.5% in May, and I'm not sure what the June numbers are, but for May that was down 44.5% since the previous month, and 22.8% since the previous year. Thing is, housing demand doesn't just disappear if they're not buying a home, and I think with first-time home buyers remaining renters, it's just going to keep that apartment demand so high, and it will keep rents elevated, and it just creates that additional pressure as more renters enter the market.
Well, and at some point, you can only buy like a new house one at a time. I was going to say once, but I mean, you can buy a house a couple of years later, but you're not going to buy a new house every other year. Usually it's every 5, 10, or 15 years, and it would seem as though many people who wanted to buy a home probably did so already. But that being said, I'm sure there's some people who put it off, and now they're saying, okay, maybe I've just gotten a increase in my salary, and maybe now I do want to buy a home. But there's still got to be some pressure just with the price increases, knowing, okay, am I buying at the top? Although we still really don't have enough houses, so I think that's a question. But to your earlier point of when things just keep going up and up and up and up and up, things have to come down at some point. And there's the saying, the cure for high prices is high prices, and at some point something's got to give to a certain extent, and I think that's kind of across the board with all things. But again, because the point really is, just construction has not kept up with household formation. And I do find this fascinating. Household formation is a major driver for housing demand in general, certainly rental demand. just again, yeah, housing demand in general, and that's an incredible spike that we've seen on this graph right here. And it really started in 2020 during the pandemic, and we're still at elevated levels now. And they're projecting in this graph, but they're still projecting elevated levels of household formation growth, which is, again, it's a major driver for demand of households. So that's great. People are moving out. People are getting married. Their households are being formed. We need more units. We don't even have enough We don't have enough units for the existing households today. Yeah. So again, they're also talking about price of lumber. Tight supply does push prices higher. That makes a lot of sense. And so then I think that, Matt, this might be a good transition. Soaring U.S. rent. This is from Bloomberg. Soaring U.S. rents are the sticky inflation with staying power. And I think that's true because rents, once they go up, unless there's a major event like a major recession or a pandemic, which rents didn't even go down in many markets during the pandemic. They did in the gateway markets. They didn't in the Midwest or the Southeast or much of the West.
And it was a story, if rents are going down, that's a big story in and of itself. It was so. There's virtually zero, but very little chance that rents in general will go down outside of a global catastrophe. And so the knock-on effect is what this article kind of is getting to, and it does seem very I don't want to say overdetermined, but it's like it's coming at from both sides. There's the construction difficulties, and then there's the huge demand. And I think that chart that you're kind of hovering over is really illustrative, and even the projections pre-pandemic, it has outpaced. I think that there's just this crazy amount, this need really for more housing. No, we've been undersupplied. We didn't really build enough, and that kind of comes back to the last Marcus and Millichap article. You can see the completions, after 2008, just absolutely. I mean, they went to less than half of where they had been. But at the same time, you see this household formation. It declined during the recession a little bit, but households are forming. People didn't stop having babies. People didn't stop immigrating to the United States. The population didn't stop growing, but we stopped building enough houses to kind of keep up with that track. And then what this doesn't show is all of the units that are actually going offline from disrepair. They're just too old. They're just, for one reason or the other. So, And so it's a lot of factors. And so, kudos to you if you are already an investor in real estate in general, multifamily investor, single family investor. You're getting a really nice pop and a lift right now. It's great for our investors, our portfolio. That's what I was going to mention.
I think there's still room to run though.
Yeah, that's what I was going to mention. If this is the driver of inflation, and even if it's just one major factor among many, it really highlights the ways in which multifamily assets specifically and other kind of commercial real estate can track or even outpace inflation.
Yeah.
So for investors that have these assets, it's very beneficial.
Yeah. Absolutely. Okay. And so then I think this all kind of, weaves itself in and out of each other, kind of going to more putting pressure on supply than anything. Reason did a really great article. I think that you and I felt a little bit vindicated after reading it, because we did a big video and piece on the eviction moratorium and a lot of the negative consequences. And,
I remember telling you, I said, Spencer, here's the thing. There are these studies that say that eviction moratorium really did help.
Yeah, no, and because the whole idea of the eviction moratorium is that people are going to be evicted and they're going to get COVID and they're going to die. And there's going to be 40,000 people were going to die, or a lot of individuals might die because if they will be evicted, if they're at risk of death from COVID
or spreading it,
or at least spreading it. But it said that there were a lot of people were going to die if we did not have this eviction moratorium. I mean, that was essentially the feeling, and they're based on these studies, a handful of studies. And Reason did a really deep dive into those studies and really kind of debunked a lot of the premises. Or then some of the studies would not even provide them the actual data. They're supposed to be somewhat peer reviewed, and they were saying, well, these haven't been peer reviewed yet, so we can't give you any of the actual data yet for you to look at. At the same time, the people who are doing these studies are on media tours, going on, CNN and wherever, saying, we just did this study. People are going to die if we don't have the eviction moratorium. And then even defendants defending the eviction moratorium in court are using their studies that aren't transparent, aren't saying how the study did, and deeply flawed it's not just they're not giving information, like the methodology just doesn't make sense.
And it's in the rhetorical effect of saying, yes, look at these studies. That's not there. No one's going to capture the nuance of these unpublished studies. The effect is, oh, this is a study. Okay, then I believe it. There's the evidence right there. So it was misleading to present even these unpublished and unpeer reviewed studies as fact. Sure thing. Yeah.
No, and so the courts used it. Congress used it as evidence to continue to argue to renew the eviction moratorium, and it basically it's BS. Like the more or less, like the studies didn't really prove anything one way or the other if you actually look at the data that some of the studies will show. So if you're at all interested in the eviction moratorium, check out this piece from Reason. It's a little long, it's a little heady, but they really go into the details, and it's worth taking a look at. Again, it is long, but I thought it was absolutely fascinating. And the one piece, and the one thing that I got out of it, and we didn't make the connection when we did the eviction moratorium earlier, and it's more of now looking around of what's happening, because I'm going to all these apartment buildings, and pre-COVID, it seemed like everything, at least in the markets that we're in, everything is 92 to 94% occupancy. That's what we saw a lot. Maybe 95. 95 was really okay, wow, you're doing really good. It was 92, 94 for a stabilized property. It's I can't go to an apartment now that's not 98 to 100% occupied. And so that's one, the demand, household formation. On the other hand, if you've got 1 to 2, maybe 5% of your residents, your tenants that are on some CDC declaration and they're not moving, those units, those are basically taken offline. You've basically removed supply from the market. And so you have full occupancies. And what do apartment owners do when you're at full occupancy? You raise the rents. You're 98% occupied. Okay, time to raise the rent. I only have one unit available. I'm not gonna, okay, well, I can probably get 10, 20, 30 more dollars, or I'll at least raise that rent, $25. And if no one rents it, okay, I can always lower it back down a little bit, give a concession. But the result is making housing more unaffordable.
Yeah.
That's what the eviction moratorium has done. It hasn't helped anybody.
It's just one more ingredient, like you said, to this recipe of if people, and this is what it seems like there is going to be articles soon about, oh, these rents are raising so high. These rents are raising so high. Well, they did create a situation that could have raised rents because of these policies. And we just learned rents don't really come down that easily. So
it's frustrating. Just very rarely does the government know the right solution. They may be able to identify the problem, but it's the solution tends to have unintended consequences that have a rippling effect throughout the economy that just manipulate the market that could function in somewhat normally and work somewhat most of the time, but it's hard to tell when you're putting these kinds of regulations on the market itself. Okay, but let's I guess we'll stay on politics for just a second, even though this don't love talking about politics, even though it might seem like we do. I think it just gets us more heated than anything.
Yeah.
Politico.
Just
Matt,
to kind of fly through. So the Politico article, I think, is an interesting, and I'm just going to briefly touch on this, is that in the wake of the pandemic, state governments are doing well. Some of these are doing well financially. And my take on this, and again, this is just a brief take, is that improved budget situations may reduce the need for higher taxes. But again, that's a political question. I think that the Globe Street article on politics and CRE is a more directly addresses those connections, especially in the title.
Yeah.
But it does a little bit back up my sense that changing tax policy is not that big of a legislative priority. Earlier in this,
you can print the money.
Yeah, just print it.
No one cares. Taxes. You can just print the money.
Just add another zero in the account.
Yeah. Well,
it just seems like now, I mean, earlier in the spring, we were kind of reading a lot about corporate taxes and capital gains taxes, partly in the context of funding for infrastructure bill, but also it was just highly talked about. It seemed like a bigger priority for people, but those voices now don't seem to be as loud as they used to be. And the Globe Street article specifically points to gridlock as a factor. And my take is that given this gridlock, the Democratic majority is not going to waste time pursuing dramatic measures that have little chances of passing. They're going to waste their breath trying to kind of completely reform the tax code. And I don't think that we can expect anything like that anytime soon. Globe Street article did implicitly raise the idea of legislation to address the lumber shortage in connection to housing supply, but it did not go into detail, and it's just a big question mark. I don't know how they would do that without maybe messing it up.
What are they going to do? Like, what are they going to do? What are they going to like?
True. Yeah.
And again, it's the Ronald Reagan. What's the most like the horrifying thing American can hear? It's I'm from the government and I'm here to help. I'm going to solve the problem. It's like, please don't.
Yeah,
just
stop the problem.
Just stop trying to fix anything. You keep breaking things.
Yeah.
Anyway, no surprise. I mean, we'll see what gets done. I think that I think infrastructure probably will get done, and it's pretty well known. I mean, one big thing gets done first term for president, and like they get one thing done, and maybe infrastructure is going to get done. And at the end of the day, I mean, Democrats like to raise taxes for part of the class war, but like we're not really talking about meaningfully increasing or decreasing the deficit or reducing the national debt, or we're not talking about fiscal responsibility. Like that's like the guys, but like. And we've said this before, like we're so far past fiscal responsibility. Like if you want to have a serious conversation about fiscal responsibility, then we have to talk about entitlements. And if we're not talking about entitlements, we're not talking about fiscal responsibility. Raising taxes, it's just a political move to have some class warfare and we're just going to steal from the rich to pay for the poor. We're not balancing any budget. We're not really paying for anything. And I don't believe that, you can just print forever. But I think that's what we're doing. And, I think it's a drop in a bucket, honestly, for a lot of what they're doing. It's growing the size and scope of government. And it is a tax in the form of inflation. I mean, higher prices, erode the purchasing power of buyers at some point. But I think over the last 10 years, when they printed a ton of money and quantitative easing was, full force, and we're still buying, what is it, $140 billion of whatever, the Fed is buying. And I think they can just keep doing it. They think they can get away with it without much effect if it's just future growth, more employment. And, okay, so you're going to spend $1 trillion on infrastructure. That's not, think about this. So that the Fed is buying $140 billion a month, or say $100 billion a month. So they're going to buy over $1 trillion a year, 1.2 trillion, more than that. Okay, that's infrastructure. But infrastructure bill is supposed to be spread out over 5 years. So it's what the Fed is doing is like a fraction. You just stop the bond buying for a couple of months, you pay for infrastructure. You don't have to raise taxes. Again, not a political scientist or economist, but it seems crazy. So I'd love to hear everyone's comments about all this below. Okay, RealPage. Again, this is kind of really just shoring up a similar theme, but U.S. apartment rents and occupancy soar in June. We've been talking about this. And again, Greg Willett from RealPage. He just always on top of putting out good information. Someone to connect with on LinkedIn as well if you'd like to kind of follow up on this stuff. Matt, any
this is actually
what were the
something
big
that
takeaways?
that you I'm going to steal a point that you made in earlier discussions today, and I'll get to that in just a second. But the RealPage report on apartment demand, which they measure by the net increase in occupied units, continues the thread from earlier. Rents are going up because housing demand is not going away, and this is what I mentioned is as buildings get more expensive, they need to raise rents to pay for the cost of construction. That's kind of the paradigm, at least in the near term, that we're having, it costs more steel and lumber. So they have to raise their rents to make the numbers work, so that they don't really fall deep into the red. And when new buildings raise their rent by so much, at least in the near term, it might be a little easier for existing buildings nearby to raise their rents. If they have to increase rents by 150 or $100, then maybe a nearby place is like, oh, well, I can increase it for 50. It could be some, and you described it earlier as like in the long term, yes, you're increasing housing supply, and therefore the demand may go down. But with such high demand right now, this could be a real thing, and because of the expensiveness of the building itself, apart from its ability to alleviate the supply, the price of the wood and the steel could elevate rents outside of that kind of direct
and I think it's also the labor and all the other all the other costs. And in the short term, if you're charging $1,000 per month and you've got a nice place, and then something opens up down the road that is maybe a little bit nicer, but they're charging $1,500 a month. Okay, well, you're not like the brand new thing, and you probably can't also charge $1,500, but I bet you could, $500 different top end. You're not, like C class, you're not going to be able to compete that closely. But over time, the aggregate of all that supply in the market does have at least a leveling off effect of rent growth. And so you've got a lot more supply. You're going to see some, stagnation. But just the increase of prices, we're kind of gapping up a little bit in terms of those rent growth. And I think we're going to be seeing over the next couple of years of deliveries, significantly elevated levels of rent. We're even seeing it in some projects that we're pursuing that, they were built last year, but the one property, they've already raised rents on some units $500. So I think we're going to continue to see that.
Yeah.
Pretty amazing. Okay, so this was a great episode of Great Report Roundup. Matt, do you have any kind of closing remarks, any kind of thoughts, any other either predictions, or what's on your mind?
I think I made all my predictions I need, but I do, I'm reassured that the sky's not falling, and gravity does exist, and I think that there is going to be some stability. So it's worth it to be optimistic.
Yep, I think so. Again, I think it's one of the most exciting times to be alive as an investor in just about anything, but especially multifamily apartments, commercial, other asset classes in commercial real estate, but especially multifamily. A lot of exciting things going on. And if you're not already participating, I think it's a great time to get involved. And so one great way to participate, especially if you are an accredited investor, is to hop on over to graycapitalllc.com. And again, we mentioned you can sign up for our free weekly multifamily report. That's the Gray Report. That's what we covered today. All these great articles. There's so much that we didn't cover. We just covered a handful of articles, and you get all this delivered to you every single week. Thursday, links to original content on the Gray Capital blog, all kinds of good stuff. But then, you need to stay in touch every single day. It's not just a weekly thing, although sometimes you don't have the time. Hop on over to grayreport.com. It is the premier real estate aggregator covering the multifamily industry. And you'll see a lot of these articles that are featured on the Gray Report newsletter, but a lot more content updated 24/7 from a great team of experts. You can get, real time, market information. Let's see what are REITs doing. I'm interested in, mid-America apartment communities. Wow, they're doing really good. Great for them. We've got videos, we've got podcasts, we've got it all. So hop on over to grayreport.com to stay up to date. And again, if you're ready to take the next step, you want to learn more about multifamily investment opportunities provided by Gray Capital. Well, the best way to do that is to join the Gray Capital Investment Club. There's just a quick form to fill out, and you'll have an opportunity to schedule a investment strategy session with, investment expert from Gray Capital. And what we do essentially is we really take a deep dive into what your goals and objectives and criteria are for investing in real estate. And if investing in multifamily apartments, with a similar strategy that Gray Capital has aligns with you, well, great, we'll have that conversation. And if not, if there's a different strategy, we're happy to talk you through that strategy and try to help you kind of put you on that right path. So, we don't call it a real coaching call. It's much more of a strategy session. They're complimentary to all the members of the Gray Capital Investment Club. And again, you join the club, and then you can click that next button, and you can schedule. Look, you can schedule a call with me. I'd love to have a conversation with you. These are about 30 to 45 minutes long, and I've got some availability coming up. All right, thanks again for watching this roundup and recap of the Gray Report newsletter. And thank you for watching this on YouTube or wherever you're watching it. If you are watching on YouTube, if you could do us a big favor and give this video a like and subscribe to the Gray Capital YouTube channel. It really just shows us that you appreciate the content and what we're doing here. And just, again, thank you so much for doing that. And, again, if you're not signed up for the newsletter, do it. All right. My name is Spencer Gray. I am the president of Gray Capital LLC and the host of the Gray Report. Matt Bosnagel, thank you again for being on the Gray Report and bringing us through and putting these newsletters together. Again, like I've mentioned before, we just get so much positive feedback. People are getting so much value from these newsletters. And so we just want to thank you for all the time that you put into putting it together every week. Do a great job.
Thanks.
All right.
Thank you.
All right. Have a good week, everybody. See you next Thursday.